Hello everyone, welcome to Tesla Daily News. Today is June 26th, Friday, and the following is the latest Tesla news. According to market data, Tesla shares closed at $379.71 after trading between a low of $368.60 and a high of $387.80. The stock opened at $370.15 with trading volume of about 53 million shares, compared with the previous close of $375.12. Technically, the chart shows a strong bullish candle breaking recent resistance with heavy volume, suggesting continued upside momentum but also short-term overbought risk. According to Clean Technica, Tesla Energy has entered a major new agreement together with Sunrun and Renew Home to aggregate more than 16 gigawatts of flexible home energy capacity for data centers, utilities, and large power consumers. The three companies plan to pool hundreds of thousands of home battery systems, millions of smart thermostats, and vehicle-to-grid capable devices into what could become the largest distributed virtual power plant in the United States. This capacity would be deployable in months rather than years and is positioned as a fast solution to the surging electricity demand from AI data centers and electrification. From an investor perspective, this agreement solidifies Tesla's energy segment as a scalable infrastructure player, not just a hardware vendor. 16 gigawatts is comparable to multiple large nuclear or gas plants combined, but unlocked from assets already installed inside households. By focusing on flexible peak capacity, fast-responding ancillary services, and congestion relief on existing grids, Tesla can potentially earn high-margin recurring revenue without significant incremental capex. Sunrun's CEO emphasized that the current grid architecture is not prepared for the data center and AI wave, and Tesla's representative highlighted that the answer is already in place in batteries, thermostats, and EVs sitting idle. For shareholders, the key takeaway is that Tesla Energy is being positioned as a strategic partner for hyperscalers and grid operators, in line with long-term revenue diversification beyond automotive. According to several German outlets, including Welt, WADA and Handelsblatt, Tesla is significantly ramping up production and employment at its Grünheide Gigafactory near Berlin. Management informed employees that weekly Model Y output will increase by about 20% to 6,200 units starting in July, and then by a further 20% to 7,500 vehicles per week from October. At that run rate, annualized capacity would reach roughly 375,000 vehicles, moving closer to the currently approved ceiling of 500,000 per year. At the same time, Tesla plans to hire around 1,000 additional workers for vehicle production in the near term, on top of a previously announced expansion. Including more than 1,500 new roles for in-house battery cell manufacturing, the company expects to create about 3,500 additional jobs at the site. That would bring total headcount in Grünheide to roughly 12,000 employees in the short term, with further upside as battery output scales toward an expected 18 gigawatt-hours per year. For investors and enthusiasts, this is a key signal that European demand and export volumes justify higher utilization of the plant, despite a tough macro environment and price pressure in EVs. While Volkswagen and BMW are cutting or freezing jobs, Tesla is positioning Brandenburg as a growth hub, building vertical integration in batteries and reducing exposure to Asian suppliers. Higher volume at a single site improves fixed cost absorption, and localized cell production should gradually lift automotive gross margins in the region. However, German media also highlight important risks. Trade unions criticize Tesla for resisting IG metal and allege work safety and health issues, while environmental groups continue to challenge the plant's location in a water protection area and the associated deforestation. For shareholders, these labor and regulatory frictions could still lead to higher costs or delays in future expansions, even though the current ramp suggests political support remains strong. According to HNA and other consumer-focused outlets, a new U.S. Environmental Protection Agency certification document quietly revealed key technical specifications for Tesla's upcoming Cybercab robotaxi. The document lists the Cybercab as a 2026 model year vehicle with front-wheel drive, a peak output of about 222 horsepower, and an impressively low curb weight of roughly 1,412 kilograms for an electric vehicle in this class. Most notably, the EPA filing indicates a battery capacity of around 48 kilowatt-hours and a theoretical laboratory range of 673 kilometers. Analysts cited by Tesla Roddy estimate that real-world driving range will likely land in the 450 to 480 kilometer band, which would still be extremely strong for such a small pack. The implied consumption of roughly 10.3 kilowatt-hours per 100 kilometers would make the Cybercab one of the most efficient EVs ever brought to market. For investors, the key strategic insight is that Tesla appears to be optimizing the Cybercab for total cost per kilometer and high utilization in fleet service, not for raw performance. Lower weight, modest power, and a relatively small pack translate into lower materials cost, faster charging, and less wear on components, crucial factors for a vehicle designed to run many hours each day as an autonomous taxi. If Tesla can mass-produce such a platform at low cost and pair it with mature self-driving software, the addressable revenue from robotaxis and mobility services could be substantial over the long term. According to Business Insider, the U.S. Department of Transportation under the Trump administration has proposed new federal safety rule changes that would make it easier to certify and deploy fully driverless vehicles without traditional controls, such as steering wheels and brake pedals. The proposed update would remove the requirement for brake pedals in vehicles designed to operate exclusively with automated driving systems, complementing earlier moves on steering wheels and other human driver-centric equipment. For Tesla, this regulatory shift is directly relevant to the Cybercab concept and its broader robotaxi ambitions. Today, any manufacturer wishing to deploy vehicles without conventional driver controls must seek individual exemptions from the National Highway Traffic Safety Administration, which strictly limits volumes and imposes heavy compliance burdens. If the new rules are finalized, purpose-built robotaxis without manual controls could be certified under a more straightforward framework, allowing faster scale-up by companies like Tesla and Zoox. Experts quoted in the report note that while it makes sense to remove outdated assumptions about a human driver, there is still a glaring absence of safety standards specifically designed for autonomous systems. Consumer advocates and safety groups argue that before physical controls are eliminated, regulators should require proof of extremely high software reliability, clear passenger interfaces, and procedures for emergency responders. For Tesla investors, the message is mixed but positive. Regulation is slowly bending toward enabling full autonomy, but the bar for demonstrating safety and transparency is likely to rise, which could favor players that can validate performance at massive scale. According to TechGenius, Tesla is rolling out a major upgrade to the charging analytics section of its mobile app, branded as ChargeStats 2, together with a new global free supercharging competition for 2026. The updated ChargeStats interface replaces simple bar charts with an interactive map that shows where owners have charged, adds richer metrics like total range added and spending compared to local fuel prices, and breaks down energy usage by home, work, and public charging in more detail. Beyond pure data, Tesla is leaning into gamification. The app now includes a permanent badges section that extends the charging passport concept introduced previously. Owners can earn collectible badges for milestones such as weekly supercharging streaks, visiting many unique supercharger locations, or charging at iconic stations and special events. This turns charging history into a kind of shareable digital travel log. On top of that, Tesla has launched the 2026 free supercharging competition. All charging sessions during the calendar year are automatically tracked, and in early 2027 the company will select 9 winners worldwide across 3 broad regions and 3 performance categories, such as longest trip, most unique supercharger sites visited, and most energy supercharged. Each winner will receive lifetime free supercharging for their specific vehicle. For investors and enthusiasts, this initiative contributes to higher supercharger utilization, richer behavioral data, and stronger owner engagement at limited cost to Tesla. Enhanced analytics and rewards can nudge customers to rely more on the Tesla ecosystem for long-distance travel, while the underlying data improves network planning, dynamic pricing, and future service offerings. According to Australian reviews reported by the Canberra Times, Tesla has pushed a major update to its full self-driving supervised software, with version 14.3.3 addressing several long-standing issues and delivering what testers describe as a nearly flawless self-driving experience in many everyday scenarios. While detailed technical notes are still emerging, early impressions suggest significant improvements in lane selection, smoothness of turns, handling of roundabouts, and overall driving comfort. As always, regulatory and legal frameworks still require human supervision, and the system is not recognized as fully autonomous. However, from an investment standpoint, the steady progress in FSD capabilities remains central to Tesla's long-term thesis. Higher quality and reliability could meaningfully increase the perceived value of the FSD package, support subscription uptake, and strengthen Tesla's dataset advantage as more miles are driven under the supervised system. The more capable FSD becomes in real cities and complex traffic, the better positioned Tesla is to transition toward commercial robotaxis once regulations and hardware converge. According to German sources such as Handelsblatt, there are ongoing labor tensions at the Grünheide factory despite the recent production and hiring expansion. IG Metall has challenged the result of the Works Council election, alleging that Tesla improperly influenced the campaign and limited union access on site. The case is before the labor court, and legal experts indicate that a decision could take a year or more. For investors, this underscores that Tesla's non-union stance in Europe may carry medium-term risks around labor relations, reputation, and potential regulatory scrutiny. While the immediate financial impact is limited, drawn-out disputes could complicate future capacity expansions or lead to new compliance obligations. Balancing aggressive production targets, cost control, and worker representation will remain a critical execution issue for Tesla in Germany. According to Reuters, which echoed the German announcements from Tesla Berlin, the planned boost of about 20% in Model Y output to 7,500 units per week confirms that Grünheide is on a clear upward trajectory. This additional confirmation from an international financial newswire reinforces investor confidence that the ramp is not just a local political talking point but an operational reality, aimed at serving both European and export markets. Taken together, the production ramp, in-house battery investment, and labor challenges paint a complex but generally positive picture. Tesla is doubling down on Germany as a strategic hub, leveraging political backing and local talent, while navigating social and environmental pushback that could shape the pace and design of future projects. Thank you for listening to Tesla Daily News. If you enjoyed this episode, please subscribe and stay tuned for the next update.